Hi, hello, welcome back to our YouTube channel. So today we are going to see 20 easy journal entries example. So in last video we have already covered what is the meaning of journal and what is the modern rules of accounting. So by using that modern rules we are going to record these journal entries in the easiest way. Okay, so let's start with the first one. Here I have also written the format of the journal entry. You can see the journal has a 5 columns. Okay, date, particulars, ledger folio, debit, and credit. Okay, in particulars we have to record that journal entry, and debit and credit where will be the amount, and ledger folio is nothing but the page number, and date whenever the transaction happen we have to record that date. Okay, so this is the format we have to follow for recording the journal entry. So while recording the journal entry, we have to follow the 3 steps. First of all, we have to identify the 2 accounts in that transaction. Then we have to apply the rules of the debit credit, and last pass the journal entries. Okay, that is we have seen that 3 steps in the journal video. Okay, so today we are going to see 10 journal entries. For that you have to follow these modern rules. Here I have mentioned each and every account type, that is the asset, drawing, expenses, liability, income and capital. So you have to follow this debit credit rule for these journal entries. So now start with the first transaction. Started business with cash of rupees 50,000. First of all, we have to identify the 2 accounts in this transaction. That is, the transaction is started business with cash of rupees 50,000. Here, cash and capital, these both are the accounts. Okay, cash is an asset and capital is nothing but the equity which is having the credit balance, and cash is nothing but the asset which is have a debit balance always. Okay, now cash is coming out of business. Okay, so definitely our cash is getting increased, so we have to debit it. And capital also getting increased, but capital have a credit balance, so we have to credit it, because capital have already credit balance, so whenever they get increased we have to credit it. So cash account will be debit balance and the capital will be having a credit balance. So what will be the journal entry? Cash account debit to capital account, and we have to record the amount, that is a 50,000. We have to record the narrations also, that's a being business started with the cash. Okay, next one is deposited cash into bank. Here two accounts are involved, that is a bank account and cash. Okay, deposited cash means whatever the idle cash was with you, we are going to deposit it into the bank. Means आपके पास जो कैश था वो आप क्या कर रहे हैं, यहाँ पे बैंक में डिपॉजिट कर रहे हैं. सो cash is getting decrease and bank is getting increase. Here both have assets. Okay, both are assets, so asset have a debit balance. If assets get increased we have to debit it, and when it get decrease we have to credit it. So your bank account is increasing because bank is getting money, so definitely it is getting increased, so we have to debit it. And our cash is getting decreased from us. Okay, so we have to credit it. So what will be the journal entry? Bank account debit to cash account. Third one is purchase goods for rupees 15,000. Here again, purchase goods. Just remember the one thing, while doing the accounting, whenever you see the goods, okay, these goods are for the resale. Okay, we are not going to use for us. So these goods are we are going to use for the resale. So whenever you see the goods name, you have to take the account which is a purchase account. Okay, these goods we have a purchase for reselling it, we are not going to use for us. Okay, so we have to take the account which is a purchase account for that goods. So purchase goods for rupees 15,000. Okay, so first one account will be the purchase and next one is a cash. So purchase is nothing but our expenses, so here our expenses is getting increased, so expenses have a debit balance, and whenever the debit balance get increased we have to debit it. So purchase account will be debit, and for purchasing that good we have paid the cash. So cash is the asset. When assets get decreased, we have to credit it. So what will be the entry? Purchase account debit to cash account. Next one, purchase goods on credit from Ra of rupees 10,000. Here we have made the transaction on the credit basis. Here we have not paid the cash to the next person. So whenever we do the credit transaction, we have to record the name of that person to whom we have to pay the money. Okay. So here we have to pay the money to Ram. Okay. So purchase good, whenever you see the purchase good, we have to take the purchase name. Okay, for that account. So purchase account means our expenses is getting increased, so we will debit the purchase account. And the ram is a creditors, we have to pay the ram in the future. So creditors is a liability means what? Liability is a such a obligations or a burden that creates the obligations we have to pay someone or something to the next person. So here we have to pay 10,000 rupees to the ram in the future. Okay, so ram will be the creditors for us, which is a liability. When liability gets increased, we have to credit. So just because of that ram account gets increased, we have to credit it. Okay. So here you can see through the modern rule, whenever liability gets increased, we have to credit it, and whenever it get decreased, we have to debit it. So follow this rule while recording the journal entry. So here purchase account is a expenses account and expenses is a getting increased. So purchase account will be debit, and RAM account is a liability. So liability is getting increased. So we have to credit here RAM account. So what will be the journal entry? Purchase account debit to RAM account. Fifth one is sold goods for rupees 12,000. Here again, here what is the name you are seeing here? Sale. Okay, so whenever sold good, like a purchase good, we take the purchase account. So here the sold good, so we will take the sales account, and another one is cash account. So cash is getting increased because we are selling the goods, so we are getting the income, we are getting the money. Okay, so cash account will be the debit because it is a increasing as it is gets increased. And sales is a income, just like a purchase is a expenses have a debit balance, and income have a credit balance. So sale is a income, so here our income is getting increased, so we have to record in the credit side. So what will be the journal entry? Cash account debit to sales account. Next one, 6, sold goods on credit to Sham. Here again we have made the sale transaction, but it is based on the credit, so we have to record the name, that's the Sham. So here Sham are the debtors, just like Ram was our creditor, here Sham is our debtors, which is going to pay us in the future. So we are going to receive the money in the future. So this is the asset. Whenever we are going to receive money in the future, which will be the asset, and whenever we have to give the money in the future, which will be the liability. So Sham will be our debtors. So debtors is an asset, and whenever our asset is getting increased, we have to debit it. And the sales again, it is a income, so we have to record it in the credit side. So what will be the entry? Sham account debit to sales account. Seventh one, purchase furniture for cash. We have purchased the furniture with the cash. So here furniture and cash, they are the both accounts. Okay, two accounts. So furniture and cash both are the asset, but furnitures means furniture is coming our business, so our assets is getting increased, and we are paying to the cash, so our cash is getting decreased. So cash will be credit and furniture will be debit. Why? Because our furniture is coming our business, asset is increasing, so we will debit it, and cash is decreasing, so we will credit it. So what will be the journal entry? Furniture account debit to cash account. Eighth one, paid salary of rupees 5,000. Here salary and the cash both are accounts. Okay, salary is a expenses and cash is a asset. Expenses are getting increased, expenses have a debit balance, so we have to record the salary at the debit side, and cash is getting decreased because we are paying the cash to the next person, so our assets get decreased, so we have to credit. So what will be the journal entry? Salary account debit to cash account. Next one, paid rent of rupees 8,000. So what will be the accounts here? Rent account and cash account. So rent is a nothing but our expenses. Expenses is getting increased, so we have to debit it. And cash, which is an asset, which is a decreasing, so we have to credit it. 10th one, received commissions of rupees 2,000. So cash account debit to commission receive account will be the generated. How is it? Cash account means our cash is getting increased, our assets is getting increased, so we have to debit it. And commission is nothing but our income. So our income is getting increased. Okay. Commission is nothing but our income. Okay. So income are getting increased, so we have to record it in the credit side. So in this video, we have just saw the 10 journal entries. In the next video, we will see the next 10 entries. Okay. Till that time, just revise these 10 journal entries. If any doubt, if you have, you just write it down in the comment section. In the next video, we will see the another 10 entries. Okay. See you in the next video.